Felix here. I'm going to take you through the top 7 buys in September, how to make money out of them, what the businesses are, how amazing these businesses are, how to trade them if you're really impatient, and which stock is actually best out of these 7, and also how to learn how to hedge for free. So you can remove virtually all of the risk from your stock portfolio at 0 cost. There'll be some familiar names in here, and then there'll be some less familiar names in here. And we sort of will flick in between those two. So stick around, because our mission here is very simple. We as a community want to make 1 million people financially free. And in my book, that means living off your investments and living off your trading income. That's our plan here. And in that spirit, I'm launching a brand new program here for only 100 people. And if you are somebody who's perhaps a little stuck, maybe you're 40 years old or something like that, like me, or a little older, and you're thinking, I wish I would have done a little more. I'd like to be 2x, 3x, 4x higher with my income and everything else in my life. This is, even this side, the program for you, because I was stuck. I worked like for $9 an hour for years. And then I got to, a couple of $100,000 a year, but I was stuck at those levels. I couldn't get through it. This is what got me there. These are scientifically proven steps you can take. And I'll walk you through it. It'll take 12 weeks. And I strongly believe we will 3x your income. And you might that sounds like a crazy promise. But if you're open to learning, it's completely risk-free. I'll take all the risk. It has a complete, no questions asked, 30 days money back guarantee. I almost knocked my cup off the table there. That's how excited I'm. So check it out. felixfriends.org/wealth, felixfriends.org/wealth. Check it out. Now, let's get cracking. So our first stock is a lesser known stock. You may or may not know them. It is IDEX. What does IDEX do? Well, I'll tell you in a second. Before I tell you what they do, let's just look at a snapshot of, is this actually a good business? Well, it says great on the screen, right? That's usually a pretty good place to start. So amazing cash flow health, amazing growth health. Profit is like out of this world. Price momentum basically means the stock's gone up a fair bit, and that also leads to relative value being D. Now, stocks with a profit health of A typically get a low relative value score because everybody likes profit, and therefore we get that. What do they actually do? Well, let me show you. Okay, they give you these numbers. Serving up 2.5 billion people, 80 reference labs, 10,000 employees. Nonsense. Nobody cares. Doesn't make a difference. Let me show you what the real business is. The real business is the following. They make analytical and one-time use lab equipment for veterinarians. That is CAG, companion animals. That is 867 million of the last quarter's revenue rather. Out of 940 million. So the water thing and the livestock thing, it's who cares? Honestly, not interested in the slightest. This is what I'm interested in, companion animals. And I've got golden retriever lying next to me here, Winston. That's the kind of thing we're talking about. So when you go to a vet, anywhere in the world, pretty much, you are very, very likely handing some money over to IDEX. And they make consumables, they make equipment and instruments. And the beauty here is, this is what I like about this business, okay? So there have been a lot less vet visits. Why? Well, there was a little thing called COVID where everybody was told to stay at home and wear masks and get themselves vaccinated, right? And we'll get to a business in a second that actually benefit from that. But what's the beauty? Well, people went to the vet less. 1% down. Let me get the whole thing on the screen here. This is clinical visits. So visits are down each quarter, but the diagnostic utilization is up 9%. And therefore, IDEX makes more money even people are going to the vet less because they're training their vets to use their equipment more, and the equipment is so brilliant, and vets love testing stuff. If you've ever gone to a doctor, they go, oh, let's check it out, let's test it. And I'm always like, but why? What decision can we make on the basis of that test? They always ask that. Otherwise, they're just billing you for stuff and they're prodding your four-legged friends for no particular reason. The temperature thing up the bum. What's with that? With cats and dogs? What's with that? That's just horrible. Anyway, let's move on. So, snapshot of some of the key numbers here that I love within a business. I like a gross profit margin that is 60% or more. Now, this is a company that actually makes stuff, those test kits. So typically you have 60% plus gross margin more in your kind of software space. But these guys have it because they're also running they provide software to the clinics and everything else. It's amazing. Revenue, you ever seen a more beautiful chart that goes up like that? That's pretty good, isn't it? Net income, profits, going up and up and up. Return on invested capital. And this is a number that we're going to look at a bit here. What that means is that when they invest their capital, they make 41% on that a year. You go try buying a stock or a house, buy an apartment and try to get 41% in year one. You're not going to get it. I mean, unless you're some slumlord, in which case, tell me where. Kidding. But yeah, very, very hard to do. So it's just fundamentally a brilliant business. And earnings growth, which is just a posh word for profits, is going up 20% on average in the long term. So what I always ask myself is if they can make 40% on the money they're investing and profits are going up 20% a year, tell me why the stock in the long run would not go up very substantially, somewhere in that ballpark. Even if it went up 10% a year, I would be happy actually. 12, 15, 18% is sort of what I think is reasonable here. So the other thing, enterprise value over profit. And you see that dip there? It went down. There's a dip there. And we look at the chart just in a second, and I'll tell you why I'm interested about this stock particularly right now. What the heck is this chart? Okay. The blue line is predicted forecast earnings, and the purple line is actual. So what you want is the purple line to be larger than the blue line, and down here you can see how often they beat earnings per share, beat, slight miss, beat, and then revenue, beat. You're going to have to get used to the sound. You get the idea, right? Very, very, very consistent. There was one miss there, second quarter of 2022. That was it. Everything else was a huge beat, and that may or may not have been COVID related. I'm not sure. Now let's have a look at the chart here. So what is the chart saying to you? The chart is saying to you that right here, you've got that yellow line here, and that yellow line, and let me get a yellow pen. Maybe have a yellow pen, Microsoft. And cut down on that yet? No. So that yellow line is the 50-day moving average. That's a pretty fat pen, isn't it? Moving average. And that is the line that most traders look at. So I trade, but I also buy stocks for the long haul. We are, by the way, 72% so far return on capital employed this year, which is not too shabby, is it? So come and join the community. And when you break through that from below to above, that's your bicycle. So we're almost there. And the last time we did that successfully was over here. And, we went up we went up something like 13% or 15% or thereabouts. Where did my pen go? I don't know. There we go. Microsoft says, no more drawing, Felix. You've drawn enough. You've had your fun. Stop it. Anyway, that was the idea, right? So, okay, let's move on. I like the stock, you might have realized, right? I just like stocks that make a product that is essential to their customers and they don't really change it. Now, do they have a big moat? Yes. Why? Because they have a 60% gross margin. You don't get to charge your customers that much if there is an easy alternative. So they're hooked in because they've got the equipment, they've got the test kits, they've got the software. A lot of vets actually run their whole practice on IDEX software. So it's a pretty sweet setup. Now, Palantir. And you know a little bit about the stock if you watch this channel. Cash flow, let's get a green pen again. Let's be fair. Brilliant. Growth health, brilliant. I'm actually slightly surprised by that. Price momentum, pretty good because it has actually gone up a lot. Profit health, so-so. Relative value, so-so. So we haven't got the profit health, but we still got the same price point in a sense as IDEX, right? Which has an A for profit health. So how does a C student get the same outcome as the A grade student? Well, let's look at a few more numbers here. Well, the gross profit margin is a whopping basically 80%. That's better than Microsoft, by the way. Revenue is going up very nicely, so the growth is there. Net income, yeah, we're pretty much approaching zero, so they are going to get to the fourth quarter of being net profitable in November, and then there'll be an S&P 500 inclusion. I've done a whole video on that if you understand what that means, but that's a good thing. Institutions have to buy Palantir. They can't help themselves. They have to. Anything that's an index tracker, index funds will have to buy it. Return on capital employed is negative, but again, look at the trend, right? That's really the thing here. Profits have grown 60% in the long run. Now, they're not profitable yet, so the earnings by EBITDA number is basically pointless. Just cross it out. It's not really useful. Here are a few points that may or may not be good. Okay, so they hold more cash than debt on their balance sheet. That's a good thing. They're not going out of business. Net income is expected to grow. It's actually going to be positive. Very, very impressive gross profit margin. And has gone up quite a lot last week or thereabouts. Revenue growth, however, has been slowing down recently. And I want to talk to you about the why. The stock is super volatile. I mean, it just goes wah, wah, rah, right? And Palantir shareholders are either happy or suicidal, depending on where it is. And it's not cheap, right? It's not cheap down here. Pretty high revenue multiple. So why is that? Okay. You see this headline? Big names in big tech to attend AI forum of US Senate's Schumer. The man who never shuts up. In fact, all senators seem to have that affliction. Who's going? Well, Sam Altman, OpenAI, Mark Zuckerberg, Elon Musk, Sundar Pichai, that's Google CEO, Satya Nadella, that's the Microsoft CEO, Jensen Huang, that's the NVIDIA CEO, I'm sure you know, Arvind Krishna, and Bill Gates, of course, because I don't know why, he's just there, he just is everywhere, really. We've got the Motion Picture Association, which is interesting. We've got Eric Schmidt, and of course, CEO Alex Karp. Now, I put this here because I want to show you how much the US government believes Palantir is essential. Because Google, Tesla, Facebook, ChatGPT, Microsoft, and NVIDIA, and so on, it's kind of the obvious ones, but Palantir is there as well, which is very, very important. This is from Bank of America, and somebody sent this to me. Palantir, compared to their AI picks, as a enterprise value divided by sales. So how expensive is the stock compared to how much they're selling? And they're here. They're right in the middle. Could go higher, could go lower, but they're actually right in the middle. So from the kind of AI universe that Bank of America likes, Palantir isn't expensive. They're just right in the middle, which is kind of where you'd expect them to be. Well, you might actually expect them to be a little bit higher. So I thought that was an interesting perspective to put on this. It's just to compare them to other AI stocks. So there you go. Are they consistent with their earnings? Yeah, not so much. But they seem to be learning a little. So here, they were all over the place, right? They were missing and missing and missing and missing. Revenue, generally speaking, was beating, but earnings per share was a little bit all over the place. And then they learned, and they did a good quarter. They learned the art of sandbagging. You give market a low expectation, and then you beat it. But the last one here, very, very, I mean, 500,000 out of 500 million is pretty much irrelevant. That's 0.5% miss on revenue. It's kind of like it's a technical miss, but it kind of doesn't really matter. So I think they are learning to be more consistent and to really, really sandbag. Now, one of the problems with Palantir comes back to these Muppets here, Schumer and co, because the US government has not been issuing defense contracts at the usual speed. They're sitting on these decisions much longer, God knows why, and therefore companies like Palantir are not receiving the growth we'd expect them to have. There's some whoppingly large defense contracts that are meant to come out. There's a massive UK NHS contract that should be decided any day now. I've been saying that for months. If Palantir gets those, it'll have a huge, huge, huge boost to revenue. So watch that space. What about the chart? And I put a few more details on this chart for you. And one is short volume down here. And you can see right now it's 21 percentage points. That's a really fat pen, isn't it? Let's get a little bit of a thinner pen. So again, we've got the yellow 50-day moving average line here, and we've just broken through it. You see that? We've just broken through it here. And that, again, is a screaming, not again, but that's actually a screaming bicycle. If we go up significantly, these idiots who are shorting the stock would be forced to close their positions. How do you close a short position? You buy the stock. You sold the stock, you have to buy it back to close your position. Otherwise, you're going to be bleeding like my toe was today. I dropped a massive steel bar on my toe, barefoot. Ouch, black nail and all. I don't know why I'm telling you this, but I just felt it. It's throbbing slightly. So possibly a good time. We are just, as I say, just breaking through that here. Last time we did that was down here, and we kicked off a massive rally, followed by about 5 short squeezes that went from, what is that, $9 or thereabouts to about 20. So resistance also sitting up here at $20. That's the core wall. Support sitting down here at about $13. So that's kind of the range we're moving in. How could we trade it? Well, I've gone to a website that I love because we build it, and I encourage you to sign up for it. It's largely free to use because it's just there to make it easier for actually our student community to trade. That's really the reason we built it. And what could we do? Well, you could just buy Palantir, right? And then you go up and down. For the longer term, that might work out well if you have a long-term time horizon. Of course, this is financial advice. This is just not a trade I'm recommending. I just want to walk you through what's possible. I'll walk you through 2 options here. So we could just say, okay, it's going to go up, but then you have a 50% probability of making money, right? That sucks. I don't like it. You don't like it. Nobody likes it. So what have we done instead here? Well, we've made this an 84% probability of making money. And if we make money, we make an 11% return by the 15th of September. September, yes. So how do we do that? Well, we're not buying, where did my pen go again? Microsoft, why are you messing with me? Because I didn't include you in this, seriously. There we go. Okay, so if you buy the stock right here, 50% chance of making money. You can go up or down. Now we are buying the stock here at 14.45, significantly below where the stock is trading. And therefore, we make money if the stock goes either up or, very, very fat pen again, or if it goes down. You just can't go any lower than 14.45. So at the moment, as I'm recording this, we're trading at 16.30. So almost a $2 room for error. That's why I love options. You can only do this with options. And I'll give you actual access to my entire sheet here. This is a Microsoft whiteboard document. I'll share with you the link so you can look at that in your own time and study it. And of course, ask me questions if you like. Now, that wasn't super profitable because that's like 11% profit. Can we do a little bit better? Well, we could go out a bit in time and we would have a 27% profit, 76% probabilities. We're giving up a little bit probability here, and that's by the 20th of October. And that might well be the more interesting trade. And our break-even point now is this one here, and that is 13.79. So we can literally go down more than $2, or we can go up and you're happy. See how that worked? Magic, right? So have a look at that. Basically, the way that works is you sell a put and you buy a put. It's called a credit spread. I'll give you the screenshots. So you can look at it. I'm giving away the next one here. Visa. Is that boring? Are they not kind of business? Isn't that for old people? Who the heck's got a Visa card? Well, give me a minute, and I think I might just change your mind that new banks and new finance will kill the Visa card. First of all, cash flow, amazing. Growth health, amazing. Price momentum, amazing. Profit health, it's just like a super nerd in school. All A's, basically, well, profit health. Relative value, I've told you the story. When a company is super, super profitable, well, they're going to be not that cheap. That's the deal, right? Amazing companies are not cheap. Okay, let me show you this, and let this sink in for a second. This is from the last Visa earnings call. There are 4.2 billion Visa cards out there. 4.2 billion Visa cards out there. And it's growing. It grew 7%. You might think everyone has a Visa card. No, there are some people who want some more Visa cards. People obviously have multiple Visa cards, but there you go. So we're seeing, especially in debit cards, a very, very significant growth there. Credit at 4%, debit at 8%. I think that's pretty staggering year over year, considering how long they've been around for and that everybody and their dog has a Visa. I mean, Winston has a Visa card, obviously. So let me show you a couple of other numbers that I think will blow your socks off. At least they blew my socks off. Revenue up 11%. Operating expenses actually fell. So they're cutting costs. They're being more efficient. And look, AI is going to love these guys other the other way around. They're going to be able to get rid of loads of people. Sorry for the people, but that's the reality. And just automate loads of their stuff and make it more efficient. They their earnings per share is up 24% year on year. 24%. Isn't that insane? I think it's insane for a business at all to grow this much. Should be illegal. And look at this. You don't really find a number anywhere from any company in the world that is better than this one. Gross profit margin is 97.7%. They're not giving much away, are they? They're not spending a lot. 97% gross profit margin. That says to me there is no real alternative. There is no competition, essentially. I know there's MasterCard, and they have a similar number. There's Amex, which isn't quite similar-ish, quite as good. These guys are just flipping printing money. I mean, it's a scandal how much they're ripping off their customers. So you have to own the stock. That's the way I would look at it, of course. Do your own research in all that. Revenue is growing. Bit of a COVID dip there. Net income, 16 billion, going up through the moon, 28% return on capital employed. So they take $100, they reinvest it, and they make $29 the next year. In 3 years, they've paid off the investment. And then it's all profit. That's just crazy, crazy stuff. Long-term earnings growth. So profits go up almost 15% a year on average. Tell me then why this stock would not go up by, say, 15% a year. I find that very, very hard to understand in the long run. Yeah, there'll be blips, it'll be ups and downs and stuff, but I'm talking in the long run, right? So insane. EBITDA, I don't care that much. Okay, a few more facts for you to impress somebody at the party tonight. No one's ever going to talk to you again, are they? They have a perfect Piotrowski score of 9. Who is Piotrowski? Let me show you. You want to know. Piotrowski is Joseph D. Piotrowski, who's actually American, so I don't know why I'm doing the accent. And he's a professor of accounting. I'm sure he was a delightfully interesting chap. He's a huge at parties, always dancing on the table. He's at Stanford. And he came up with a measure of the strength of a firm's financial position to tell you whether a company is undervalued. So he looks at profitability, leverage, debt, liquidity, where the funds are coming from, and efficiency. There's a little pretty chart here, which looks a bit odd, really, to me. But anyway, that's what it's about. And what's the highest Piotrowski score you can get? Sorry, I can't help myself. 9. Visa's got the highest score you can get. This is a value investor's wet dream. Maybe that's what that looks like too. All right, we're getting inappropriate on this channel. YouTube's going to tell me off. So high earnings quality, absolutely free cash flow, exceeds net income. This is one of the few businesses in the world that are very, very profitable, but they're receiving more money in their bank account than they have in profits. They don't know what to do with this stuff. Insane. Yields, super high invested capital. We just looked at that RSC, consistently increasing earnings per share, profits per share, has raised dividends for 15 consecutive years. I'm not a fan of dividends, but they don't know what to do with the money. They're going to pay it out somehow. Okay, high earnings multiple. Yeah, it's not cheap, okay? And it trades with low price volatility, doesn't really move all that much. It's just, it's one of those things. I mean, you got to own a credit card company, I would say. And look at this. If you just thought again, well, this is the past. In the future, it'll all be different. We'll all be using different methods. It'll be whatever. I don't know what it'll be, but, blockchain or something. This is just out from Bloomberg today, right? I got an email on this today, literally today. And Visa card are going to charge extra transaction fees beginning in October, followed by fees in April for commercial customers for debit and prepaid cards, and the increases, merchants will basically pay about $500 more in additional fees. And this is just another fee. Nothing you can do about it. Everyone's going to have to pay it. It's going to get marked up probably to us, the consumer, and Visa's going to get even more profitable. So if you don't want to get ripped up off on your purchases, better own the stock if you swipe that thing. Okay, so stock. Look at this. What have we done? What have we done? What has Visa card done? Exceeded that yellow 50-day moving average, and then it went on an absolute bender. It's exceeded the peak here, still trading above that, and it's just screaming, buy me, buy me, buy me, from a trading point of view. Okay, for the long term, you always have to come up with your own conclusions, do your own research. I just want to give you some pointers and hints here in all of that. So I like it, as you can see. Can we trade it? Yeah, we can. Again, I go to optionswatch.io. I'll put the link down below. And I go out 2 weeks, and I have an 81% probability of making money. 81%. How much money can I make? 20%. But you need to understand the risks and the setup and your exit strategy and all of this. So if you want to do these trades, use a paper trading account. Think of Swim has them, Interactive Brokers has them, and practice and learn. Don't just set this up because you need to know how the heck to get out of this, right? And whatever goes against you, you need to know what to do. But essentially, again, similar trade. It's called the bull put spread. We're selling a put to make money, and then we're buying a put just below it to limit our risk. But that's a pretty reasonable setup. I might actually do that trade, but of course, not financial advice. That's Visa. You want to hear the next one? You excited? You're excited to learn how to remove all risk from your stocks with hedging? Well, stick around. NEO. Oh dear. Oh dear. And look at that. It's all red. So NEO isn't our best student, according to the data, but let me explain to you why. So we've got a D for cash flow, a C for growth health, a D for momentum, a F for profit health, and relative value is sort of so-so. So they deserve to get spanked, don't they? Or do they? Well, what does the market say? Well, declining profits, but they're not really making profits. 2 analysts have downgraded them. Poor return on assets, weak gross profit margins, price momentum is volatile, fared poorly in the last month. Moderate level of debt, something positive in here, right? So are you sufficiently depressed yet with NEO? Well, let's look at it. Okay. It's a growth company. What does a growth company need to do to be a good growth company? They need to be growing. Revenue is growing, but it's had a little bit of a limp up there, but it is growing. Net income isn't growing, but that isn't really the job of a growth company. Return on invested capital, who cares? They're not making money. Long-term earnings growth, who cares? EV over EBITDA is pointless. And net income is pretty pointless, unless they run out of cash, right? Now, the whole story with NEO, and I did a whole video on this, and I might just link to it at the end. I'd encourage you to check it out. It's called NEO, I'm Fed Up. I think that's what I called it. As a big red thingy. So just type in NEO Fed Up and you'll find it. And I walk you through the actual growth story and what their plan is. NEO wants to be a top 5 car manufacturer in the world by 2030. For that, they have to grow by 19 times to get to that kind of revenue. So this would have to be a monstrous stock the size of a Mercedes, much bigger than Tesla is right now, by the way. Top 5, what's Tesla? Tesla is like 11 or 12 in terms of car sales revenue globally. So they want to be way bigger than Tesla is right now by 2030. For that, you need to spend money. Why is everyone hating the company? Because in the last 12 months, they burned through $2.8 billion of cash, $840 million just in the last quarter. But they do have cash. They've got about $4 billion. But if you're burning through 800 million in a quarter and you've only got 4 billion, it does make people worried. So what's going to happen here? Well, that Middle Eastern investment they've got, they've just spent it. they're probably going to have to bring on board some more investors to keep growing at this rate. But they're not launching any new cars apart from the 2 sub-brand cars. So the expenditure on that front will slow down. But really, if you want to imagine that NIO is a tech company that makes its money off autonomous driving subscriptions, they need to be the best there is in China, pretty much. And for that, they need to spend money. It's very simple. So it's kind of either you spend the money and you have a chance to do it, or you don't spend the money and you'll definitely go out of business. That's exactly where they are. So they are going for it. They're gunning for it. And all growth companies go to this stage where the market hates them because they don't care about profits. They're just burning money to get to the top, right? Look at Amazon for many years. I'm not saying NIO is Amazon, but you get the idea. Okay. What about the stock chart? Well, it's a bearish setup for sure. Because you've got, again, here's your 50-day moving average line. That's always my gold standard. And we're below it. We're below it. That's bad. We did catch see that purple line there? Gonna get a purple pen? Yes, Microsoft says yes. A big, juicy, fat one too. That one there. That is the 150-day moving average line. And that's giving us some support. So we're kind of trading sideways. It's kind of consolidation. But we do need to break back through that 50-day moving average line, which sits somewhere in a I don't know, 1150 or something like that. Can we trade it? At the moment, no, not really. There isn't enough money in it for the risk you're taking. So I would say a definite no on trading NIO at present. One more thing. Zoom out. I'm not talking about zoom here. I'm talking about zooming out. This is NIO since it listed. So it's listed down there at that share price, which was $9 or something like that. I don't quite remember. And right now it's trading at 1060. So there is a cyclicality, and you have to ask yourself, if you wanted to buy it up here, why would you not buy it down here, or why would you sell it down there? And we look at that at the end as well. I want to walk you through some human psychology here, which is really, really important, because most retail investors do exactly this. They buy here, they bottle out there, and they're just permanently handing their money over. When you do this, imagine you're walking down Wall Street. In fact, you could do this. You go to Midtown Manhattan, and you can take some money, $1,000, and walk up to a guy who's wearing a little vest. It'll be a little bit pale and gray. It'll be a banker. And you can just say, here's $1,000. And you know what to do with it better than me. That's what you're doing if you are buying up here and you're selling down there. And that goes for all stocks. This is not specific to NIO. I'm just saying. Unless you think the stock is really, really fundamentally underperforming, then it's the right thing to do. But if you're just bottling out because you're down a certain amount, why did you buy it at the top? It's the question, right? So what I like to do is when I buy a stock, I write down why I'm buying it. So this is what I was talking about here. This is unfortunately what retail investors do. Do you know how much money retail investors make on average a year? Investing 2%. Shocking, isn't it? Shockingly shit. We're up 74% ROCE. That's not quite the same in real terms. Maybe it's 50% or something like that. But you get the idea. And stock portfolio is up to probably 20%. So maybe take a screenshot of this and understand. You're saying, I love my investments. Everything's going up, brilliant. It's a temporary downturn. I'm in it for the long run. And then down here, the market's not going in my favor. I'm bottling out. And then they sell. So people buy up here, they sell down here, and then they repeat it until they're broke or just give up investing. And in that case, you never get to financial freedom. You just don't, because your income will never make you really financially free. You need your money to work for you, not the other way around. That's you, as I say. Come and check out what I said at the beginning, which is, where is it? Here it is. felixschwenzer.com/wealth. That'll change your mindset forever, permanently, in a really, really good way, which is what I've done to myself. Because I didn't start out with this mindset. I sucked as an investor. Yeah. Waters. Who's Waters? It's a water company, is it? It's a little bit similar to IDEX, but it's got nothing to do with fluffy creatures. Winston, you're still sleeping on the floor. Let's look at the numbers. Cash flow, amazing. Growth health, so-so. Profit to health, amazing. Stock's obviously gone up a lot. Relative value, well, that's the link from profit health to relative value. Amazingly profitable stocks are never really, really cheap. But let's look at this. This is what I get excited about. This is what every business should be doing. So what do? They sell you a piece of technology, a machine that does analysis on whatever it is that you want to measure. All sorts of stuff. Been doing this for like 60 years. They have 150,000 of those things installed at customers. They're embedded with top 50 pharma companies, chromatography data system number 1. So they also do all the regulatory submissions for these guys, for pharma companies. And then they have consumables. So to use what you bought for a lot of money in step 1, you need to buy the consumables. This is a little bit like IDEX, right? I give you a machine, you can do the tests, but you have to buy my test kits. And then, and this is the even better thing, they service the machines, and there's a fee for that, of course. And that's the beauty of the life cycle. You sell them once, you will get money until the end of time, until death do us part. Probably longer than most marriages. And look at this. Look at this. Their 2020 revenue, almost $3 billion. 49% comes from instruments. So that's selling instruments. I could spell instruments. And then 50% is recurring. This is a subscription business, essentially. This is like Netflix, but for sexy stuff. People in white coats who wear plastic glasses. Amazing, isn't it? Half of that $3 billion is just coming in. You don't have to do anything for it. It's just amazing. So, what's good about this company other than that? Massive buyback. Most people like buybacks. Okay, analysts are revising their stuff downwards a little bit. Higher return on assets, a little bit slow on revenue growth lately. Low volatility, cash flow is significant and profitable in the last 12 months. And they do not pay a dividend. I love that they don't pay a dividend. You know why? They've got something they can do with their money that is going to give you a return rather than just giving it to you. Why do you want the money? You invested it because you wanted them to make money for you. Stop giving it back to me. Are they consistent with their profits? Yeah, except for one quarter here where they failed a little bit. They've been very, 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 very consistent, right? As a management. Okay. This is what gets me really excited. This is the Waters investor relations side. And you're saying I'm a strange person. I get excited about that. But look what they put on the front page of the investor relations. They put operating margin, return on invested capital, and the 5-year free cash flow. These guys don't just know what makes a great company. They respect their investors enough to publish those 3 numbers on the front of the page. No other company does this. And are saying, these are the numbers that matter. We know they matter. Everything else is wishy-washy. And they put it on there. So I absolutely love them for that. Insane. And those are good numbers. Return on invested capital, 35%. Free cash flow, 24%. That's pretty good. Why is the margin so low? Well, they're making pretty complicated stuff. So it's a manufacturer, essentially. For that, the margin is actually pretty sweet. What about the stock? Well, it's come down quite a lot. Look, we were trading up here. It's come down quite a lot. So I actually think it's a pretty decent entry point. Again, not telling you should buy it and so on. But, we've broken here through 2 moving average lines. That one is the 200-day. That might be a little bit of a lid. But in the long run, I just like this business. Very, very simple. Because again, do your own research, right? This is what it's all about. Here's another sexy one, and then we go to one that you're much more familiar with, and give you a bit of an update on that one. So what's this all about? P&G, Procter & Gamble, Felix, really? This is a boring old value stock. Hear me out. It'll take 3 minutes of your life, and you might just change your mind. Or you can write a nasty comment down below, which I would equally appreciate. The algorithm likes all comments. You can also hit the subscribe button if you haven't already. So cash flow, brilliant. Growth health, so-so. Price momentum, yeah, pretty good. Profit health, cha-ching, right? And relative value. There we go. So super, super profitable. What do they make? Okay, let's look at the numbers and I'll tell you what they make. Gross profit margin is 48%. That's pretty good. Very, very, very steady. 82 billion revenue, growing nicely. 14 billion income as a percentage, that's pretty staggering. Return on invested capital, almost 20%. Earnings growth rate, 6%. And again, I tend to look at these two and I go, well, how much is the stock price going to go up? As a really rough measure, right? And let's look at a few figures here. High yield, high ROIC, consistently increasing profits per share, raised dividends for 39 consecutive years. So for you dividend hounds out there, this is one for you. And 11 analysts have revised earnings upwards. Relatively high PE, so it's not cheap, and doesn't move a lot, which again is usually a good thing. It makes you sleep better at night, which is important. This is what they own, and I appreciate this is a little bit fuzzy, but you'll recognize most of the labels, right? Ariel, Brown, the shaving thing, the Crest, Fairy, Oral-B, Old Spice, Olay, Tampax, very important. That's a lot of money. Pantene, Pampers, crikey, right? All this stuff. We're not going to go through them all, but you get the idea. These are serious brands, very serious brands. And look at this. Organic sales growth. I love this chart. Why do I love this chart? Not because they've grown 7% a year, which is an impressive number, but organic volume declined 3 percentage points. They sold -3%, and they made 7% more money, revenue. They have pricing power. This is what that chart says to you. They say we can just hike our freaking prices when people are struggling, and we're going to charge them more. Our products are that good that people don't want to switch from them, and they'll just pay more for it. It's a bit like Pepsi, for example. They hiked their prices 17% this year, higher revenue, right? People just drink this shit. So there we go. Consistent numbers, pretty consistent. Yeah, I mean, basically only ever one, this is Q4 2022, only one profit miss. Everything else was a persistent beat, certainly on revenue and on earnings as well. So very, very, very impressive execution there. What about the stock chart? Well, it's not super cheap, but again, it's above the 50-day moving average line here. Why are we painting over there, over here? So it's on a fairly positive bender. It's a fairly positive trend up there. Okay, then next one. This is one of the ones you might be a little bit more familiar with. And you see how what we did there? We used the SoFi blue for SoFi. I thought that was a nice touch, didn't you? Okay, let's look at this. And you know a fair bit probably about SoFi. It's a fintech company. It's probably my favorite fintech company. Growth health, brilliant. Cash flow health, profit health, relative value, we don't know. Price momentum, so-so. So it's kind of fair. It's sort of like not a bad student, not a good student. It's sort of the student you don't remember if you're a teacher. I wasn't a teacher, but I imagine that's what teachers think. I always thought it'd be better to be remembered for good or bad. Don't you think? I think so. Okay, let's look at some of their numbers. So this is a growth business, right? 81% gross profit margin. Oh my God, that's amazing. It's amazing. Revenue going through the roof. Profits, almost zero. So they are at the cusp of profitability. That's typically where growth companies get wider interest because a lot of investors don't want to buy loss-making businesses, right? Pension funds and so on. And long-term earnings growth rate, 43%. So they're obviously doing something right here. Let me show you what they're doing right. Members. They call their customers members. It's a bit of a, I don't know, cliquey family sort of thing. They added almost 600,000 new members in the last quarter. They now have 6.2 million customers. That's a pretty sizable startup. And these are people who put money in that. Let me show you how this business works. So this started off as a student loan business. And the idea was we'll take people from good universities with good degrees, you're going to get good jobs, and we'll earn more than the average American. And we will refinance their student loan at a better rate or stretch it out more or whatever. And then the government came in and said, this is communist America, and we're going to suspend all student loan payments, and we're going to bail it all out, and that wasn't legal, and so on. And this communist dig, by the way, I would make the same thing at a Republican government. I have no interest whether you're Democratic or Republican. It doesn't really matter. I'm just saying this kind of change by a government is not free market. It's the opposite. So that's why I'm calling it the communist move. And what has SoFi done in that period? Well, they've taken their student loan customers and they've sold them financial products. They now have lending here in blue. So let me get a dark color. So this down here is lending. This is where the student loan thing came from. They also do mortgages and stuff like that now, but it's not such a big thing. And then this up here is basically financial services. So what they have done is they've taken this relatively small base and they've upsold them again and again and again. And they've upsold them to their money product, their investment product, their rebate product, their credit card product, and so on. And that's insane because they now sell 5 financial service products for every lending product. And this is this cross-selling thing that Anthony Noto, their CEO, is so obsessed with. And you can see why, because it bloody works. And the company's grown. They've beaten their forecasts, their guidance, despite the government taking away their core business. Right? That's execution. No one got up at SoFi and said, oh, we're going to have a really, really rough time now. We're going to underperform until the government puts this back into place. And this is a mindset lesson. Anthony Noto knows what he's doing. He could teach this, right? So if you want to change your mindset to a place where your business gets taken away from you, your income gets taken away from you, everything is just frozen, and you don't go, no, I'm going to have a tough time. You go, brilliant. I'm going to do better than I thought I was going to do without all that stuff. That's what SoFi's done. So come and check out felixschwenzer.org/wealth, and we make you into an Anthony Noto. That's the plan. Second reason I like this business, Galileo, they bought this. This is basically the back end of SoFi. It's also the back end of Robinhood, of Klar, of Revolut, of BitPay, and all these other online companies. So if you're using Robinhood, you're giving money to SoFi. Brilliant, isn't it? They are the back office. They are the system. They're the tech stack. SoFi owns the tech stack. These companies on here do not. People often don't know that. So there we go. Are they consistent with beating things? Yeah, I'd say so. Okay, this down here is arguably the impact of student loans with earnings per share, but these are very minor misses. But revenue and, the last 3 quarters here, it's very, 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 very high quality execution there. Now, the chart is volatile, to say the least. We're below this famed 50-day moving average line. So that's not good, right? That was a sell signal, and we're still down there. We're kind of popping up towards it, but in the short term, it's still not looking all that wonderful. But again, the question is always like, do you want to buy these businesses at the top of the chart or somewhere in the middle, or maybe just every week, Okay, so we've gone through 7 stocks here. Let me know which of these you prefer. Don't cheat. Do it before I show you the data. And then we're going to look at a bit of a benchmark here. And we're not going to go through every data point because that would be tedious, and we've covered some of these. But I just want to do a comparison of these. And this is a massively unfair comparison. I would normally compare an IDEX against other companies in that space. A Visa, I compare it against MasterCard and Amex. And comparing it against competitors is usually more useful, but we just want to see what kind of businesses they are. So let's highlight the best. Highlight the best, and then we highlight the worst. Visa card has the best gross margin, right? Insane. But look at Palantir and SoFi, pretty close, right? Operating income, again, no question that Visa is the best there. Return on invested capital, IDEX is the clear winner. Net income margin, basically, what's the profit margin, right? Who's got the highest profit margin? Well, Visa card. But again, 20% is pretty good. Cash conversion cycle means, do you need financing? When you sell something, is your customer paying you upfront or later? IDEX is 114 days. That means they need money to run it. Visa, minus 79 days. They get paid up front. That's why they got more free cash flow than profit. Procter & Gamble gets paid up front. SoFi gets paid 8,000 days up front. That's a bit of an odd number, but they do get paid up front. Free cash flow. So we'll have to zoom out a little bit so we can see these here. The best free cash flow out there, again, Visa, Palantir, pretty impressive. None of these are massively indebted. Waters is probably the highest level, but they can all pay their interest. Palantir isn't profitable, so there isn't a number for that there. It doesn't really matter. And let's go to the other side here. Put the stock names on this side as well so you can see it. So who's got the most consistent earnings per share history? Visa, Procter & Gamble, and SoFi. Best management execution, I'd say. Long-term earnings growth. What's the actual long-term growth? Not last quarter, not just last 2 quarters, but in the longer run. Palantir, very impressive. SoFi, very impressive. So you get the idea. Shall we score the worst? Let's do it. Let's do it for fun. And then I'll teach you how you can hedge for free. NEO, yeah, definitely. They were near zero, and now they're spending a lot more. But you could also say management is just more confident, and they therefore feel like they can. Earnings per share, again, same story, NEO. Let's look at these ones here at the beginning. Who's got the worst gross profit margin? NEO, sorry to say. It's just not really a fair comparison. It's a manufacturing growth company. We haven't got another manufacturing growth company up here. So we should almost exclude NEO from this. Net income margin, well, Palantir isn't quite there yet, but that's going to be zero soon, and then profitable, and then S&P inclusion. So again, you have to understand where they are at. And leverage free cash flow, okay, SoFi isn't quite there yet, but you know, it's a growth company, as I say. What about our Piotrowski score, which I keep pronouncing like he's Russian? He's apparently American. Who's got these glorious scores? Well, Visa is the perfect score. IDEX is an 8. Palantir is a surprisingly good number, I must say. Surprisingly good number there. That's kind of interesting. And then the others are sort of somewhere in between. But those are standout numbers. Okay. Are you ready to learn how to hedge for free? I hope so. If you haven't already, subscribe to the channel while I pour myself some water. So, how do you do it? Okay, to hedge, the way you hedge is you buy a put option. And if you go to optionswatch.io, and I put the link down below, go to optionswatch.io, and you can basically select over here a long put. And that means you're buying. Long means buy. I don't know why we say long. Maybe we should just say buy and sell. Might be more clear. If you say, hey, I want to make money below $15, you buy a put at $15, and that costs you $11.50. So the cost is $11.50. And you might think that's not a lot. And so say SoFi goes down here to $13, you would make a 1,700% profit on that, right? You turn the $11 into almost 200. It'd be pretty good trade, right? And this, by the way, is until, this is a 9-day trade, so it's about a week out. That's what I would normally do. And then you do this every week. But that burns through cash, right? Whatever you're spending $11 every week and you're not making money, you do this for 10 weeks in a row, you burn through $100. That kind of sucks. So how do you pay for this without putting up any money? This is the opposite of the trade. This is the second part of the trade, or maybe even the first part. What we do is we sell a call option. And what does that do? So this is the profit loss diagram up here. So up here you would lose money, and down here you make money. So we sell it above the share price. I've selected $17.50 here. So if Palantir stays below $17.50, we make $17. Yeah, so funny enough, the price and what we make is the same. So you receive $17, and then you take most of that $7 and you buy a put with it. Put's $11.50. So you're actually making $6 on top. That's a pretty sweet setup. Now, what's the risk here? Well, the downside is that if Palantir share price suddenly jumps up by next week from 1630 to above 1750, that gray line here, above it, you're selling your shares at $17.50. So it's not like you're not making money, but you're selling it automatically at $17.50. So you have to buy it back. That's your downside. That's what happens when you sell essentially a covered call. That's what that is. But it can make you money to reduce or eliminate your risk. And I think these are quite smart setups. And I think if you do them every week, it takes 3 minutes to set up every Monday, your risk that the stock price goes massively through the roof and you miss out on a rally is relatively limited because you're doing it always a week out. Stocks don't move that much usually over the week. And you have protected your downside. So you'll sleep better at night. And I think it's worth it. And you're making probably a little bit of extra money as well. So run through this. Use a paper trading account, please, to practice this. Don't use your real money. How do you use a paper trading account? Well, there are basically a couple of brokers that offer what they call paper trading accounts. In the US, definitely use Thinkorswim. It's just really, really good and really easy to use. In the world, anywhere else in the world, you have to use interactive brokers. And it's free, doesn't cost you anything. Don't need to open even the real account, just use the simulated one and practice this. And once you learn this and you're confident with it, then you can think about doing them for real. If you enjoyed this video, I thank you. I thank you for joining the community. Have a look at our program here at the Wealth Accelerator. If you want to, especially if you are stuck, or if you're not even stuck, like a lot of people have. I used to be like that. I had a nice life, nothing wrong with it, but it wasn't extraordinary. And you deserve to be extraordinary because you are. And you deserve to have a really special life where you make an impact, where you do everything you want to be doing and you look after your loved ones and just enjoy yourself while having an impact and while earning more money than you've ever earned. Then come and join us. FelixFriends.org/wealth. Thanks for watching. Tallulah says that if you enjoyed this video, watch one of these other two. One is the NEO video I mentioned, which goes more in depth than anything you've ever seen on NEO. And the second takes you through the 9 most common mistakes that pretty much all investors make. So check it out.